Hello and welcome to my morning note. Yet more soccer analogies are in order today. Not only did Germany go down to a startling but conclusive defeat to Italy in the soccer, but a few hours later it appears that Germany went down to something of a political and economic defeat at the EU summit. That's at least how it's being presented and how the market is responding. Perhaps the critical point is that the European Union's bailout mechanisms are now going to be allowed to inject capital directly into banks. That's an attempt to break the vicious circle between banks and sovereigns, and it's something that the markets really wanted to see. Now, it's had an immediate, very strong effect on markets. Stocks are up very strongly in Asia and in Europe. The yields on Spanish bonds have fallen very drastically. The euro is up. I would note, however, that the spread between Spanish bonds and German bonds is still at this moment higher than it was 1 week ago. It's not at all clear whether this is the beginning of a really big rally or just something that could dissipate within another 24 hours. Plenty then to discuss with my guest, who is the head of equity strategy at BNP Paribas here in London, Gerry Fowler. Gerry, we've obviously had a very strong immediate reaction to this summit. How can we go about assessing whether this is going to be a lasting market move, like the one we saw after the LTROs from the central bank 6 months ago, or whether this is going to dissipate in a short period of time?
Well, I guess there's two things that surprise me most, or that we can look at. The first is that the break of the banking sector from their sovereigns is a very important statement to be made, that they do intend to have European-wide regulation. So we may see that come through in the volatility levels of the banking sector in particular. If those come down sharply, then there may be a lot more faith in the stability of the European financial system. The other thing, also somewhat derivative related, is that a lot of the uncertainty that we've had recently is it's created what I'd call intervention illiquidity. And so if we start seeing some of the liquidity come back into markets, particularly the price of variance swaps versus their replicating option portfolios, if those narrow, we may get a lot more confidence that this is a genuine recovery. Now,
it would be nice if we could try to work out ways of making money without having to place bets on the way that politicians are going to behave. One very interesting point that you've made recently, which you can illustrate here, is that there may be something interesting going on in the relative performance of large and small cap stocks. You know, we all know in the very long term small cap stocks outperform. But as you can see, it's been really quite a radical outperformance going on for over a decade here. What might be the reasons for expecting large caps to outperform, particularly in the States?
Well, first of all, particularly in the US, the trend has already reversed over the last 12 months. We think it continues. One of the main reasons, you can see this trend here, one of the main reasons for the reversal, we think, is that the large caps in the US in particular, but globally in general, have exposure to growth that's international, and particularly quite a significant exposure now to emerging market growth, that even though these emerging markets are slowing, it's still more significant than US domestic growth. When you look at the US domestics, the small caps are much more exposed to those, to the tune of 80% of revenues versus 60% for the large caps. So they're more sensitive to consumption trends and construction trends that are much more US domestically oriented. So with an expectation that growth may be under threat next year around the fiscal cliff issues, then if we get negative surprises on growth, the much more lofty small cap valuations and the much more lofty growth expectations in small caps might well disappoint a lot more than the relatively cheaper and relatively muted growth expectations in large caps.
Okay, and there's also some points to be made about liquidity and asset allocation out there. If you've had an extreme of asset allocation and people start moving back into equities, then it was the large caps that will benefit most at the beginning because they're the easiest to buy in a hurry.
Yeah, when large money needs to move, it tends to, well, it needs to find a home in the things that are liquid, which are the large caps. So we've seen several examples of that. In 1986, there was a very significant spread between the bond yield and the equity earnings yield that made equities look extremely relatively attractive. We're at that situation again. We're not necessarily expecting a huge bond to equity transition unless we, in the next 6 months, but it's at least the reverse, the transition to safe bonds is abating, and we may get some of that liquidity coming back into equities over the next couple of years to drive this performance. The tech bubble was another example where there was so much liquidity going into tech stocks that it drove massive large cap outperformance in the 90s.
Okay, Gerry, thank you very much indeed, and in particular thanks for coming on very quickly after becoming a father.
Thank you.
First time. To try to sum up, obviously it's still very difficult to see exactly where the markets are heading after the latest European developments. For the longer term, it may be very sensible to start moving more into large caps.